Pitfall number two is large financial losses. So in a time frame where the market has really bubbled up, it sent a lot of your TSP investments into record territories, right? If the stock market were to come down, which most people are invested in the C fund, which is the S&P 500 market cap index, and remember, a market cap index weights its its companies according to the valuation, which means based on the price of the stock. Um, this is how bubbles create. Okay. And when we look at the price of the S&P 500 market cap, which is your C fund, it's at 22 times earnings. It hasn't been at 22 times earnings since 2000. Okay. That was a bubble in terms of the tech bubble. So can the market continue rallying to higher P ratios, price to earnings? That's basically you're paying a price for paying 22 times $1 of earnings on the S&P 500 right now, which historically is 16 times. Could it continue doing that? Sure. But if we go back to the average, historical average of what we pay for $1 of earnings in the S&P 500, which is 16 versus currently 22, quick math on that, that's 30% correction. If we have a 30% correction at any given moment, how long does it take to break even? Well, if your average earnings are 5%, then it takes 7 years to break even. If your average earnings on the market are 8, it'd take you under 5 years to break even on that loss. So, you know, avoiding losses can really make or break and be the difference maker in someone's successful retirement or not, right? Especially if you're on the cusp of retirement. Someone that's got many years left, I wouldn't say be so concerned about the current setup of the market, but someone that's got under 5 years definitely ought to start to look at how they're currently invested in that thrift savings. Because at the end of the day, if you go into a difficult market in the early years of your retirement, and you're withdrawing, let's say, 5% of your TSP, which was valued at $1 million, and you run into the teeth of a pretty lousy or bad recession, back-to-back year losses, I mean, you can have your TSP quickly in a withdrawing down phase. If you're lucky enough, like most of the retirees that have escaped in the last 10 years, to have great years in your first couple of years of retirement while drawing down, that does next to nothing on your TSP balance. But if you're on the outside of that and you get unlucky, you can really create damage, which is why you want to start thinking of your TSP in buckets. Each bucket corresponds from when you're going to be using the money. A long-term bucket is always going to be your funds like C, S, and I. Those are those are investments that are beyond really a 7-year withdrawal situation. Those are long-term investments. And if they go down by 30% over the next couple years, you're going to give that plenty of time to recover. But if you're in a situation where you're going to be needing money in the short term or midterm, this is when you want to stash and start creating really more of a short term investment bucket, like your G fund or your F fund in the midterm. You really want to start to create something that's going to be less volatile that you can withdraw from in case of an emergency, especially if you're in retirement, right? You don't want to be withdrawing from anything in long term. That thing's going to be down 30% if there's a recession or worse, right? You want to give that a break, withdraw from these other areas of your retirement strategy or TSP, not the long term. So this is how we want to visually think about this. Now, one of the aspects of the TSP that is a little problematic for a retiree is that even though you build out these buckets, the TSP doesn't allow you to choose these buckets in retirement to withdraw from. Unfortunately, when you give them a withdrawal request, they sell these proportionately to send you a check. That's not exactly what you want when you're in retirement. You want the control of saying, okay, lousy market this year in the S&P 500, I'm withdrawing from my G fund, right? As of right now, that's not an option, right? So these are things that you want to think about as you start getting out towards your retirement years. But this is by far one of the best strategies to employ on creating a basically laddered approach to withdrawing your money from these different risk buckets that you've set up.